Welcome back to Starting from Scratch, my 8 episode journey created especially for complete novice investors. I'm Patricia Saylor, managing partner of Saylor Financial Fundamentals, and I'm excited to guide you through today's episode. We'll begin with Alyssa's story, a journey that may feel familiar to you, and by the end, you'll have a vocabulary list, review questions, and a homework assignment to reinforce what you've learned. Let's dive in. Alyssa settled in and flipped open her laptop, excited to continue her investing journey. As she checked out a few financial websites and read the headlines, she saw references to the market using terms like the Dow and the S&P 500 and Nasdaq. She had heard these terms but never really understood them. What does all of this mean? She wondered. Her grandmother had often talked about following the markets and how important it was to understand the big picture to know if she was making good choices in her investments. When Alyssa was younger, she had heard but not understood what her grandmother was talking about. Now she was determined to understand these concepts. She typed into her search bar, "What are stock indexes and what does it mean to beat the market?" Today, she was going to learn how the market's performance is measured and maybe even discover how her investments could stand up against the giants. If you listen to financial news, you may hear that the market is performing well or poorly at a particular time. There may be positive or negative predictions about what the market will do next. These descriptions may include references to the Dow or the S&P 500 or the Nasdaq 100. Sometimes the financial news will indicate that the market is up while a particular stock or stock sector is down, and vice versa. Since each stock performs separately, financial services companies have developed several ways to evaluate overall stock market performance. In 1962, Standard & Poor's Financial Services Company created a list of 500 large companies bought and sold on stock exchanges in the United States. S&P wanted a way to measure the overall strength of the U.S. economy, so they used the performance of these 500 companies to track how well the stock market was doing. The S&P 500 still represents the broadest measure of the U.S. economy. It changes daily as the prices of the 500 companies fluctuate. The Dow Jones Industrial Average, often referred to as the Dow, is the oldest measure of stock market performance, dating back to 1896. The Dow represents 30 large-cap stocks as determined by the Wall Street Journal. The Nasdaq 100, created in 1985, represents the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. It is generally regarded as a measure of the technology sector's performance. These 3 ways to measure the stock market performance are called indexes or indices. The performance of these 3 indexes is usually pretty aligned, though sometimes one performs better or worse than the others during a given period of time. But together they give a good indication of how the market is doing, and you can check their performance on any given day in the financial news. Many investors like to compare their personal performance to one of these indexes to see if they can beat the market. To beat the market means to achieve a higher rate of return on an investment portfolio than the overall market average. In other words, if an investor's portfolio outperforms a stock market index, such as the S&P 500 or the Dow Jones Industrial Average, then they are considered to have beaten the market. This is a common goal for many investors, as it can lead to higher profits and a greater sense of success. But I'll tell you now, it is really hard for individual investors to beat the market with their own stock picks. I'm pretty good at it, but some of my success has come from good luck. I was lucky that my losses on Teladoc and Tattooed Chef were much smaller than my wins on Shopify and Nvidia. Early on, I bought Shopify and sold it at the right time. I was an early adopter of Nvidia stock, and even after selling enough to make a hefty profit on my original investment, I still own quite a few shares. But I know good fortune has played a part, And as I approach retirement, I'm moving most of my own funds into steady ETFs and focusing on dividends. So when you get started, you might just want to select an index fund or two or three and let the experts put together a diversified portfolio for you. And if you're not sure what that means yet, don't worry. Stick with me and I'll steer you in the right direction to learn more on your own. Or you can read the sections about index funds in Chapter 2 of the Novice Investor's Guide, or take my online course about selecting your investments. You don't need to make any purchases just yet. Focus on getting through all 8 episodes in this series, and once you have set up your own account and made sure you have investigated any opportunities your employer offers, you'll be ready to start shopping for investments. As always, let's make sure you have grasped the most important information from this episode with a vocabulary self-check, some quick review questions, and a homework assignment you can share in the comments with your fellow viewers. If you are still unsure about any of the terms or questions, you can sign up to download a free PDF answer key on my website, which is linked in the video description. First, check your understanding of these terms. You should be able to use each one in a sentence. Stock index, Dow Jones Industrial Average, or the Dow, S&P 500, Nasdaq 100, large cap stocks, market performance, financial services companies, rate of return, beating the market, economic measure. Now, make sure you know the answers to these questions. What is the primary purpose of a stock index? Explain the difference between the Dow, the S&P 500, and the Nasdaq 100. How is the S&P 500 used to evaluate the strength of the U.S. economy? What does it mean to beat the market? Why might an investor want to compare their personal investment performance to an index? For your homework, I'd like you to do some research on a stock index that interests you and share your findings in the comments. Here's what you should do. Choose a stock index and maybe consider one other than the Dow, S&P 500, or Nasdaq. For example, the Russell 2000 or the Wilshire 5000. Find out which companies are included in that index and why it was created. What are the top 10 companies in the index? Write a short summary of your findings and share it in the comments below. Bonus. Check how the index has performed over the last year and compare it to another index. Share whether either has gone up or down. I look forward to seeing what everyone is researching. Next up is the part you've been waiting for, how to actually make money in the stock market. Episode 5 will cover capital gains, dividends, and give you a brief introduction to options, which you'll be ready to learn more about after you've been investing for a while. Don't forget to like this video if you found it helpful. Subscribe to my channel for more tips on investing, and check out the links in the description to access additional resources.